Well, the trend indicator that we've been watching reached down to that level. We saw some selling take place, mainly led, if you're looking for specific narratives, a lot of that came from Janet Yellen's remarks about the debt limit. You can see here, CNBC, Congress must raise the debt limit by October 18th. Treasury Secretary warns the default. I mean, come on. I mean, they're going to raise it. No way they're just going to default on all of their debts. That would be crazy if that's the case, but I doubt that highly. Also to note that consumer confidence, that fell, unexpectedly falls to a 7-month low. I don't know about unexpectedly, but it definitely did fall. What happened to the markets overall? Well, red across the board. Should you be panicking right now? Because everyone's panicking. Personally, I don't think so, and I'll tell you why in today's episode. Dow Jones down almost 600 points, S&P 500 2%, which is a pretty large move for the S&P 500. I believe that's the fourth time we've seen a 2% down day this year. Don't quote me on that, but I read that somewhere. And then I also read that happened 16 times in 2020. So yeah, 2% down. Okay, we haven't seen a 5% correction for quite some time, and then we finally got it, and now we're seeing a 2% day in a single day. 2% down in a single day. Blah. 3% down almost in the NASDAQ. Small caps down 1.45%. The only sector in the green is energy. And you can see here the lead weight, the anchor of the ship was technology. You can't be too shocked at that, right? We've been seeing the 10-year spike up higher. We've been talking about when that rallies and ramps up higher. It puts pressure on tech, and we saw a big fall today. I'll get into that here soon. Energy led the way. Oil took a little bit of a stall today, reached higher, tagged into this top area of resistance. Could be stalling out, could be digesting. That was a very strong rally. Last time we saw a strong rally, kind of went sideways like that. So we'll continue to monitor and see this. But, it's looking overall very strong. I wouldn't be shocked to see it move up, come down a little bit, and then, take another stab at trying to take up, go higher. Okay, the dollar shot up, broke past this resistance. Now let's see if we can get some follow through. Remember what we've been saying. When the dollar heads higher, the S&P 500 and equities fall down. Where do you hide today? Where do you buy? Where do you go for safety when everything's in the red? There's only two places you can really go. You might think, go gold, go silver. Well, you can't do that when the dollar's flying up because that puts pressure on various commodities and precious metals. So you go into volatility, right? And you go into the dollar. Those were the only two safe bets. Now, if we take a look at volatility, we were looking at this inverse head and shoulders. We said, yeah, I can see it popping up and filling that gap. It popped up. It didn't actually fill the gap. It popped up within the middle of the gap and then just rocketed higher. Now it could be potentially forming a bull flag. So we'll keep an eye on that. But honestly, I think this is all driven by what was going on at Congress. On the testimony today in Congress. That's where I think that this was taking place from. So let's see if this is just one little pop and now we get that drop and we could come down and fill these two areas. One reason why I think that VIX can head lower is simply because we'll look at just here, the advanced decline issues, okay? First off, it's getting oversold again. Once we get down to these low reading levels, bam, bam, it produces pops to the upside. This was a pretty dramatic move to the downside, okay? 2%. Right, gap down, follow through down. Typically, so that is a trend day, it's trending downwards. It's rare to get follow through trend days. It's not impossible, but typically what we've been seeing is you get, maybe just an inside trading day or, a range day following a trend day. We are getting that overextended area, which tells me, hey, we can bounce here. If you look at the weekly time frame, it's still inside of last week. So yes, today was a crazy, scary day, but really we are sitting within the trading week of last week still. So nothing crazy going on at this particular point in time. The only implications that we've been watching is this trend break. We came up, we said, okay, that was a very strong move on lower volume. Guess what? We sold down to the lower Bollinger Band and we're right back at that 100-period moving average. We need to take out this low to get a little bit more scared, right? That was at 4,300. So we'll continue to watch that. There's the bull flag that we were keeping an eye on, and we said we're gonna say gap up or gap down. We gap down through the 5-day moving average, bounced, and it was just selling all day today. Okay, All right, we're back below the 5-day moving average. It started to flatten out. That's back to neutral. So it's a time to be obviously cautious. We have one gap above us that can act as a level of resistance. If you take a look at the TNX, 10-year yield, right, pop even higher today. That put a lot more pressure on big tech, okay? And you can see here in the bonds, they've been just falling off a cliff, okay? One thing to note here, it is getting a little frothy. It could get frothier, right? But that's getting into overextended territory. So if this starts taking a little bit of a breather, right, we might see a little relief rally take place in tech. And I mean, everything is kind of setting up for a monster relief rally. I mean, if you know, we're getting all this fear in the markets right now, okay, coming up to the whole debt ceiling debacle. Once they raise the limit or raise the debt ceiling, that could be setting up for just a monster relief rally where all of a sudden yields take a little bit of a breather, right? And then all of a sudden we see big tech go bonkers. If you take a look at TLT, obviously this has been going down very dramatically. It's not really too oversold yet, but that is some excessive movement to the downside where we can potentially see bounces too from those areas. So it's not something that you want to just jump in front of. All right. Think of like, you know, if you see a couple of dollars out in front of a bulldozer, do you just want to like risk your entire like portfolio or your life to pick up a couple dollars to potentially lose, you know, just destroy a portfolio? No, you don't want to do that. So at least focus on managing risk. Now, when the 10-year yield rises, we see that pressure on tech. So we're looking at the NASDAQ 100 right into this area of support. The next area of support that we'll be watching is 14,500. That's slightly below the 100-day moving average. If you take a look at the 15-minute time frame, we broke down through that bear flag. We said it can reach to around 363, cracked right through it, came back tested, headed lower, closed pretty much on the low of the day, and then we have a positive divergence taking place in the RSI, okay? So yes, it's getting pretty extended. Now, what's crazy to me is tech has been really the NASDAQ 100, even this S&P 500 been held up by like the Fangman stocks. And one of the strongest performers has been Google. Google was up about 60% on the year, and it's still up year to date 55%. So watch Google, right? It's only down 7.7%. So hasn't even had a correction yet. So if this heads lower, that can put a big anchor, a big drag on the NASDAQ 100. So, you know, it's something to watch out for. You know, all the FANG stocks are important to watch, but this is obviously a big behemoth that we want to keep a very close eye on. Another thing why we could potentially bounce is our indicator here, the RSI, on the BP NDX chart. It's getting pretty overextended to the downside, right? And we can see relief bounces from those areas. We saw when we got here, we saw a little relief bounce. So we're back down. Might get a little bit of a relief bounce. We'll see here soon. If you look at small caps down on the day, right? But we're really just right in the middle of the range still, right? We saw this aggressive move, got digested. Okay, so nothing too crazy really, you know, out there. Yes, we saw an uptick in volume on that down day, so that's notable, but we're still above the 200-day moving average. You know, a lot has to be done. We got to see this week pass really to feel a little bit more confident. If you look at the 15-minute time frame, we saw some selling, obviously. Look how it got below the 5-day moving average, retested and started heading lower. We still have two gaps beneath us. Those could act as levels of support, so we got to see here if we can recoup that 5-day moving average. Meanwhile, the Dow Jones Industrial average was down almost 600 points. You know, yeah, pretty aggressive move to the downside, rallied very hard, and now we're seeing increased selling pressures. I can see us retagging 34,000. That makes sense. This is a very aggressive move to the downside. I would say what bears probably want to see would be a gap up, and then they could fade the gap up. All right, but if we get a big gap down, it could set us up into overextended territory, even more so where we are, where we can get potentially dip buyers to step in. You know, pins and needles. The market's on pins and needles. If you look at this rising wedge on the DIA, we did, you know, we cracked down yesterday, but then we just didn't see any follow through. Today we got that gap down, moved down lower, back below the 5-day moving average. That is somewhat inclining right here, just short term. Came back up, tried to back test it, and then we closed right there on the low. So, a lot of stuff going on. All right, that's all I really have for you on today's episode. This is kind of my thought process. I think that there's a lot of fear out there, a lot of panic. I definitely see the opportunity for a bounce play here, but you need to be very mindful of what you plan on risking. Why am I not that freaked out? Why am I not that scared? We have a lot left into the week, okay? But we're still trading within the range or we're still trading within last week's range from open to close. So it's still an inside trading week as it stands right now. Yes, we've already seen massive move, right, in price action in just 2 days time. The options market priced in, I think it was like around a $74 weekly move, and we've already blown past that, and we're underneath that kind of expected territory. So it's more than possible to see a rip up. Just be careful out there, because volatility is one thing that's going to be on just every trader's mind, and you just never know, right? If this is a bull flag and we start busting out here, yeah, we can obviously head lower. But as it stands right now, a couple of the indicators that I'm paying attention to will suggest that we can see just a minor bounce. So yeah, that's all I got for you on today's episode. Be careful out there. I will see you back here most likely tomorrow.